Hello, I'm Chip Stites, and this is the Laughing Retirement. This is also a market update. I don't do market updates on a regular basis because I think they have a tendency to get stale. I try to do market updates when there are reasons to do market updates. So let's talk a bit. And let me share screen here. Now, it's September, and I don't know whether you've noticed or not, but the markets have been a little bit volatile. So let's talk about where we are today first. Well, first of all, on July 31st, the S&P 500 was at 55.22. A month later, August 30th, it was at 56.48. It was up about 2%. On September 9th, it was at 54.71, or down about 3.1%. The NASDAQ on July 31st was at 17,599. On August 30th, it was at 17,713. And on September 9th, it was at 16,884, or down 4.7%. Now, basically, what that says to you is we have increased volatility. Another word for volatility is risk, but risk comes in many forms, not just the movement of a stock price up or down. So September and October are known for increased volatility. And what that usually feels like to most people is increased risk, because when the market is moving up, nobody says, oh, this is risky. But in fact, the higher the market gets, the riskier it is. We just don't feel that way. Although that really doesn't make any sense. As the market gets lower and lower and lower, it's actually safer. But then again, we don't feel that way. Warren Buffett's famous for saying, the enemies of the equity investor are expenses and emotions. And yet we let our emotions run away with us constantly. September and October are generally pretty volatile months, yet at the same time, there are other events right now that are affecting our markets, and there are a lot of them. Now, we know we're about to get a Federal Reserve rate lowering. Now, why do they lower rates? Well, generally they lower rates to avoid a problem. And so we know historically that either slightly before or slightly after a lowering of the Fed rate, we get market volatility, or we get a lowering in the market. Why? Because they don't lower rates when things are good. When things are good and all's going well, they raise them. And so right now, we are looking at a few problems, and let's look at that a bit. Well, first of all, gold is at all-time highs. As of September 9th, it was at 2502.85. But the all-time high is 2531. In other words, it was 29 points away from an all-time high, and that was in August of this year. Now, another thing that is going on, now I'll go back a second. Gold doesn't go up because things are good. Gold goes up because people are worried about what's going to happen in the future. And gold is historically the standard of value and has been for millennia. Gold is gold. And it is one of the things that people trade regardless of how good or bad things are. And they trade it more and more and more when things aren't good. And so you see gold going up as a result of the worries we have in the market today. Now let's talk about another worry. Let's talk about the BRICS. The BRICS are Brazil, Russia, India, China, and South Africa. They are, for the most part, not huge first-tier economies. Exceptions probably China, close behind India. What are they doing? Well, they have ceased to trade their oil in dollars. Why is that? Well, I don't know if you've noticed or not, but the euro is worth more than the dollar. So is the gilt or the UK pound. They're worth more than dollars. Well, why is that? Well, the reason very simply is that our debt is 133% of what we produce every year. Congress doesn't seem to have much interest in fixing that. And the name of what we produce is called GDP. Now that stands for all of the gross domestic product, the goods and the services that we make every year. So our debt is consuming 133% of what we make every year. Now, one of two things has to happen. The dollar has to go down. Our taxes have to go up in order to pay for it. And you'll notice there isn't, in an election year, any mood at all to raise taxes. So we're in the midst of a contentious election at best. Add to that the fact that the labor market's kind of faltering. Although, if you listen to the talking heads, they're saying, "Oh, well, we're going to climb out of this." Maybe. I hope so. The labor participation rate is low. Now, what's the labor participation rate? Well, very simply, that means the amount of jobs available versus the amount of jobs that people are actually participating in. And right now, the jobs are available here and the participation's down here. That's not good. So the labor participation rate is falling. If the economy were stronger and we had more manufacturing, or we had more this and more that, that wouldn't be happening. The other problem we're looking at is that we have more low-paying service jobs than we have available high middle-class jobs. That's a problem. In other words, there are a lot of things taking place right now that affect the value of the perceived value of the stock market. Because remember, the price of a stock today is what many people believe the value will be 6 months from now. It's not just today. It's today taking in somewhat of tomorrow. Now, what can you do about this? Well, if I were within 5 to 10 years of retirement, especially 5 years of retirement, I would not want to bet on whether or not we had a recession, how much the stock market was going to drop, and how long it would take to get out of that. Because if I knew I needed money in 5 to 10 years, and this is where I expected to be, and I was in stocks, I'd be concerned about what I had. And if you're not, you're making a mistake. Financial advisors do things by a formula. In other words, if this is your risk profile, this is what you get. And it's generally done with mutual funds or ETFs. So what can you do? Well, one of the things you can do for yourself is to add physical gold, and it can be in an ETF or it can be in a mutual fund, but it's not a mutual fund that holds options on gold. It's a mutual fund or an ETF, exchange traded fund, that holds gold. Very simply. Put at least 10% of that in your portfolio. Because if things get worse, gold will go up. Yes, I know it's an already all-time high, and you're supposed to buy low and sell high. But if you don't have it, gold is a stabilizer for things that are not good. Putting gold in your portfolio makes sense. You can also decrease the number of growth holdings you have in your portfolio. Now, what do I mean by growth? Well, there are Morningstar style boxes. Value, blend, growth. By going from growth to value in those style boxes, large, medium, and small, you can decrease the risk in your portfolio. And we're going to talk about that. we're going to talk about growth versus value, and it's one of the last things I'm going to say in this report, and I want you to listen to it, so hang on with me. The other thing you can do is take profits and increase what's in your money market fund. Don't leave it in cash. It doesn't pay you anything. Put it in a money market fund, which right now should be paying over 5%. So we are adding gold. We're taking profits. We are decreasing the number of growth style investments and increasing the number of value style investments. And we're going to get rid of any fund or ETF that holds the Magnificent Seven. And that's Alphabet, Amazon, Apple, Meta Platforms, Microsoft, NVIDIA, and Tesla. The Magnificent Seven. Now, why do I say that? When I started in this business, my mentor said, if everybody else is doing it, run the other way. In 2008, one of the reasons that my clients only lost about 11.5, 11.7%, and we had it all back in 18 months, was because I got rid of anything that had to do with housing. Anything. And I added food, I added utilities, I added things that people had to have. I added oil to my portfolios because all of those things are defensive. And that's what I'm suggesting you do now. You see, the Magnificent Seven is not unique. It's not special. It used to be the Nifty 50. They'd given a lot of names to it. In the late 90s, it was the dot-coms. Before 2008, it was housing, mortgages. Is this new? No. It's just part of the pendulum that swung all the way over here. And sooner or later, I don't know when, but it will come back. So what can you do? If you're within 5 to 10 years of retirement, or you're in retirement, even more important, add at least 10% gold, number one, in a ETF or mutual fund that holds physical gold. Number two, take profits, add them to your money market holdings or to CDs. Decrease the growth style holdings and add to value style holdings. Get rid of any ETF or mutual fund that holds the Magnificent Seven. Go to the last quarterly report and see what they hold. If you're looking at Amazon, Apple, Alphabet, Meta Platforms, Microsoft, NVIDIA, or Tesla, sell it. Get rid of it. Because those have the highest value and therefore the highest risk. Now, what else can you do? Warren Buffett famously said, rule number one, don't lose money. My first mentor said, I've already told you this, if everybody's doing it, run the other way. You can increase your bond, short and intermediate term, high quality ETFs. Those are safer. If, and I would say when the markets start to fall, don't panic. The enemies of the equity investor are emotions and expenses. You can lower your expenses and know that you're prepared. Now, what do? I don't have anything to do, in truth. First of all, because I've already done some of this, but second of all, because I keep a portfolio with low risk, high dividends. It's an all-weather portfolio all the time. I don't have to mess with it much. As a result, I don't expect to lose much, regardless of what the market does. What's my history? Well, in 2022, the S&P went down 18.1%. I was up 3.4%. In 2023, the markets were up 24%, and I was up 0.32%. Now, you look at that off the top of your head, and you're going to say, well, wait a minute, you get your butt kicked. Really? Let's look at the numbers. If you do those numbers on $1,000, the S&P was worth $1,016.67 at the end of 2023. My portfolio was worth $1,037.30. I take 50 to 65% of market risk. Right now, it's probably a little bit less. If you have any questions about this, if you have any questions about what I'm doing and how I'm doing it, number one, watch the videos on this channel. Number two, send me an email, info@thelaughingretirement, and just put questions in the headlines. I'll answer you. I always do. I want to read you something. This comes from Jeremy Siegel's book, Stocks for the Long Run. One of the many books that I read because it's good on history and it's good in explaining things and it's good at what happens over time. I know that we are hooked into growth. Don't be. Listen. Historically, value stocks, those with lower price earnings ratio, and I know that's a financial term, but price earnings ratio is nothing more than the price of one share of stock divided by the earnings of one share of stock. That's all it is. Company knows how much it earns. They know how many shares of stock they have out. So you divide the shares of stock into the earnings, and that's the price of one. That is the earnings of one share of stock. You know what the price of one share of stock is? That's pretty easy. It's posted every day in the markets. Historically, value stocks, those with lower price earnings ratios and higher dividend yields, have superior returns and lower risk than growth stocks. Tilt your portfolio towards value by buying passive index funds or value stocks. I buy value stocks. And I buy value stocks when they're down. As a result, I haven't been buying much lately. But that's okay. Because what I want my portfolio to do over the long run is succeed without a whole lot of risk. This has been a market update. I look forward to hearing from you, and I hope you'll watch the rest of the videos we have on our YouTube channel. I'm Chip Stites, and this is The Laughing Retirement.